Welcome to the 2017 first quarter investment call with the San Diego Foundation. Thank you for joining us today. Quarterly investment calls are an enhanced service to donors. The calls provide direct access to our investment leaders in a consistent, convenient, concise format so donors can remain informed about the performance of their charitable assets. Leading today's discussion will be Horacio Valeiras and Matt Fettig. Horacio Valeiras is the president and a principal of HAV Capital, LLC, and serves as investment chair for the San Diego Foundation Board of Governors. Horacio has more than 24 years of investment management experience. He is a portfolio manager for the HAV International Growth Strategy and oversees all investment and trading functions. As Chief Investment Officer for the San Diego Foundation, Matt Fettig oversees and manages our investment strategies and activities. This includes working with the Board Investment Committee, senior staff, auditors, professional volunteers, fund managers, and outside consultants to establish, maintain, administer, and monitor policies related to foundation investments. Today, Horacio and Matt will start the call with a brief macroeconomic update, followed by performance and attribution reports for our endowment portfolio and our long-term, medium-term, and short-term portfolios. We will conclude with a 10-minute question and answer session. To submit questions for the Q&A session, please use the questions chat function anytime throughout the call. Any questions unanswered during the call today will be answered via email. Attendees can access slides and a recording of today's call on our website at sdfoundation.org next week. Now, Horacio Valeiras will get us started.
Good afternoon, everybody, and thanks for joining us. We're going to look at a few charts of what's happened, really, and we'll go back all the way to the election. We'll start with the price movements post-election, which is shown in the chart on your screens right now. If you look to the left, you'll see a point where all these lines cross. They've been rebased to the day of the election or the day after the election, and the different lines show you the performance of different asset classes and/or sectors, as are shown in the bottom. If you look at the top line, the light blue line, that's a Russell 2000. That's small cap stocks, and they have the best return over almost 15% since the election. The next one, that light blue line, sorry, that orange line is the Russell 1000 financial services. So basically, coming out of the election, small caps and financials, which were going to benefit dramatically from reduced regulation, from a steeper yield curve as the Fed raised interest rates more rapidly, outperformed quite significantly. Since early March, though, they have started to underperform. As you can see, they peaked almost at about a 20% return, and they've started to underperform the market since then. On the other hand, if you look at the bottom line, the light blue line, that's the Bloomberg Barclays U.S. Treasury Index. You can see that sold off. It was down almost 4% at its worst in December of 2016, and has since been rebounding to the point where it's now only down about 2% from where the election was. The reason that I bring up these charts is because one of the points we want to make is that it looks like the Trump trade, which was the financial small cap sell-off of treasuries, has begun to reverse itself, and we've seen that in the markets, and we'll talk a little bit more about that as we go through some of these charts. If we turn to the next chart, you'll see where we stand today on valuation. Now, in previous calls, we've talked about how valuations are stretched around the world and for most asset classes. You can see that here if you look at the price to earnings bar charts, which is the second one from the left. You'll see that EFA, which is Europe, Australasia, and the Far East, so that's basically non-U.S. stocks, are trading at about 21 times earnings. The U.S. is trading at about 22 times earnings, while the emerging markets are trading at 15 times earnings. If you look at price to cash flow, you see a similar picture, except that the non-U.S. stocks, the EFA stocks, are much cheaper than they are on a price to earnings basis. So they are generating, those companies outside the U.S. are generating more cash flow than they're generating earnings. And you can see that the U.S. still leads the pack with the most expensive valuation. And if you look across all the valuation measures, price to book value, price to earnings, price to free cash flow, dividend yield, or earnings yield, you'll see that the blue bar is either the highest on the price to valuation measure or the lowest on dividend yield and earnings yield, meaning that the U.S. stock market is on any of these measures the most expensive one in the world. The reason we show you this is because one of the things that Matt will talk about when he talks about our positioning is that we are favoring non-U.S. securities in the portfolio, particularly non-U.S. equities. Now, should this be a warning to investors? Well, we don't think so, because interest rates remain very low around the world, and central banks are still feeding a lot of liquidity, even though the Fed here in the U.S. is raising interest rates. In other places around the world, central banks are keeping very loose monetary policy. So we would expect valuations to be high, but it's certainly something to keep in mind. If we flip to the next chart, you'll see where we are economically. And as you all know, the first quarter in the U.S. was not a particularly good economic outcome. So that year-on-year GDP growth in the U.S. is now running about 1.2%. Inflation has started to come down, and it's now down at about 2.2. It peaked at about 2.7 towards the end of the year. And our unemployment rate has continued to strengthen. As a matter of fact, today's employment figures from ADP, who puts out a number of private sector employment, was another strong number, which means that companies continue to hire in the U.S. So the economies are doing well, even though GDP growth may not look particularly robust. We are still seeing significant expansion of employment. Europe, we're seeing a little bit better growth at 2%, and unemployment, that should be 7.8%, has come down quite dramatically in the last few months in Western Europe, and really pointing to how the economies there and the companies are doing better and hiring more people. The thing to focus on is the bottom 5 lines in this chart. The BRIC nations, Brazil, Russia, India, and China, are 5 emerging markets, which are still showing pretty good economic growth. You can see that in aggregate, even though Brazil's economy is shrinking, the BRIC countries are growing at over 5%, with about a 5% unemployment rate. Inflation is still tame at 2.9%. And we think these numbers really are, economies that aren't too hot, too cold, but appear to be just about right. With a combination of low interest rates continuing around the world, we think the environment is still good for risk assets. And then finally, if we turn to a more forward-looking view of the world, which is the next chart, you'll see the yield curve in the U.S. Now, what this is interest rates at various points in what's called the yield curve. So anywhere from 1-month treasuries to 5-year treasuries to 7-year treasuries, 15-year treasuries, all the way out to 30-year treasuries. And these are the interest rates that you are being paid to buy these securities today. These are all government securities. There are 3 lines here. One is today's line, which is a dark blue, so that's a spot rate. And you can see that short-term interest rates are a little bit over 1%, and the long-term 30-year bond yields about 3%. Now, the 10-year bond in the U.S., which, as I mentioned before, dropped immediately after the election, bottomed at a rate of about 2.6%. We're now back down to about 2.2%, which is still a very low interest rate. Historically, that 10-year bond has averaged somewhere between 4 and 5%. But what's interesting here is you can see if we go 6 months out, if we use a forward curve to tell us what investors are expecting interest rates to be in the future, The 6-month curve, the orange curve, is showing that short-term interest rates are going to go up by about 0.5 percentage point in 6 months, and then another 0.5 percentage point in 12 months. But yet the long-term interest rates stay pinned, basically about where they are today. What that's telling you is that investors are expecting the yield curve to flatten. And usually when that happens, we would expect a slowdown in the economy. So don't expect the economy to heat up. Hopefully we'll keep this kind of sort of ideal environment here going for a while longer. So with those comments about the economy and the markets, I'll turn it over to Matt to discuss the strategies.
Thank you, Horacio, and thanks everybody for joining. The returns you're seeing here are through the first quarter ending March 31st of 2017. We'll start with a review of the endowment, and as always, I'll take a little bit longer here to talk about some of the themes that are also present across the portfolios that we manage for you. The endowment had a very strong first quarter at 4.6%. You can see now for the 1-year period ending March 31st, up 12.5%. And pretty handily outpacing its policy index for each period that we're showing here. There has not been a dramatic change in the asset allocation of the fund, as you see in the pie chart on the left. But it is noteworthy to mention that we did surpass the $450 million mark in the endowment and the $700 million mark in terms of total assets at the foundation. To follow up on some of Horacio's thoughts, talking about valuations in the U.S. versus the non-U.S. versus emerging market countries, we did see that theme play out in the portfolio. And as you've heard me speak before, if you've had a chance to meet with us or listen to this webinar, the foundation has been positioned, particularly in the endowment strategy, with a relative overweight position in emerging markets, with what I'd say more than normal exposure in the non-U.S. markets, and more neutral exposure in the U.S., though still substantial. And I think of important note is that we've had a very strong, robust U.S. stock market for a number of years now, where large cap and small cap stocks in the U.S. have really led the way. And that has changed here over the past few quarters. So if you look at the first quarter, emerging markets were actually the strongest performer, up over 11%, followed by developed non-U.S. markets, up over 7%, then followed by the S&P 500 or the U.S. markets at 6%, and small cap was really the lowest performer of the markets, up 2.5%. So, really the returns that we experienced in the first quarter really played well into our positioning, and you will see that throughout the endowment portfolio, the long-term portfolio, and even the medium-term portfolio to a certain extent as well. The second thing I want to mention is the bond market or the fixed income market. Many of you have probably heard that bonds are extremely overvalued, and in many cases we would agree with that. And if you look at the Barclays U.S. Aggregate Index, it's the index that most people use to track the U.S. bond market. Over the course of the last year, that index is about flat. It's up 0.4%. And if you look at the bond portfolio that we managed within the endowment, that was up 7.7%. So really a large variation from the index to the upside. That is a function of some of the positions that we have outside of the traditional bond market, such as high yield bonds, emerging market bonds, And it's also the result of the performance of a few of our managers that have just really been standout performers. We have one in particular in the endowment that has done quite well over the course of the last year. We have a different manager in the long-term and medium-term pools that has done just about equally as well. So that is another reason why we've had some relatively strong performance in an absolute sense and also against our policy index. As you know, in the endowment, we also have other diversifying assets. That would include areas like hedge funds, real estate, and private equity. Over the last year, our hedge funds have contributed 9%. We think that's a pretty strong return given the environment for hedge funds. And our real estate and private equity portfolios have been very strong diversifying performers for this portfolio as well. So we've really been hitting on all cylinders. Let's move to the next slide and talk a little bit about the long-term portfolio. Again, a very strong quarter, up 5.1%, and the one-year period ending March, up 12.5%. Very similar themes here as to what I discussed with the endowment. It was really this overweight to areas like emerging markets and non-U.S. developed stocks that were really big contributors. We also utilized this manager in the fixed income portfolio, as I mentioned, that just really had standout results and helped us really outpace the bond market. Keep in mind here that we run this as a very liquid portfolio. So all of our alternative investments are liquid. Our real estate exposure is not through private real estate like it is in the endowment. It's through real estate or REITs, which are publicly traded securities. And all of those markets have been quite additive. Heading to the next page, the medium-term portfolio, you can see results were robust, not as strong, but our objectives for this strategy are to deliver lower volatility returns. Therefore, those returns are going to be lower. You can see, nonetheless, quite strong over the one-year period, up 7.4%. Over half of this portfolio is invested in the fixed income market. So where we do have equities, some of the themes I described earlier hold up. But in the fixed income portfolio, we just have much more exposure. And as I mentioned, fixed income, for the most part, was flat over the course of the one-year period. Our exposures to those other areas and to some strong managers were very helpful for us over the course of the last year. And then finally, I'll conclude on the short-term portfolio. Remember, this portfolio is largely invested in U.S. money market funds. For a long period of time, when interest rates were at zero, there was no yield in this portfolio. It was returning nothing. And as we've seen a few interest rate increases in the U.S. now, we are seeing some yield come back to this portfolio. So over a period of time, this yield will become more meaningful and certainly will increase further if there are further rate increases from the Federal Reserve. So with that, it concludes our formal remarks. We are happy to take questions. As you know, you're able to submit questions through the question and answer panel. And we have a couple questions as of now. Feel free to submit more if you have any. The first question is about the policy index that I described. What is it? And wouldn't it just be simpler to show our results against the S&P 500, a more well-known index? So I think that's a fair question that deserves some discussion. And if you go back a couple slides, John, you'll see at footnote at the bottom that describes what the policy index is. And it's different for every pool. But the idea is, if our portfolio consisted of, let's say, 100% U.S. stocks, then the S&P 500 might be a very good benchmark to measure our performance against. However, you can see in the pie chart on the left-hand side of this page that we're only 25.7% domestic equities or U.S. stocks. We're also 26.4% international equities. And there just happens to be another benchmark for international equities called the MSCI EAFE, or ACWI, that is more appropriate. So that all the policy index is a weighted index of indexes. So in other words, for our domestic equity exposure of 25%, we would use the S&P perhaps to measure that exposure. For real estate, for the 4.4% exposure there's a real estate index, and so we would weight that 4%, et cetera, with all of the different indexes adding up to 100%. So it's a much better way of measuring the actual asset classes that we're using, as opposed to kind of comparing apples and oranges. A portfolio measured against the S&P would simply not be the best index, given that we're investing in other areas of the market. Another question, Horacio, I will tee this one up for you. Will pulling out of the Paris Climate Accord affect the way in which we invest or cause any changes to the way we allocate assets?
Yeah, that's an interesting one, especially since the president just announced a few hours ago that we were pulling out. But it's going to take a while to see what the impact is. First of all, it was always going to take a while to see what the impact of the accord would be, and it's going to take even longer, I think, from what I read after the announcements, that we wouldn't pull out until sometime around 2020 anyways. So I think that this one is one we'll keep an eye on, but no impact on how we're investing, no impact on any of our present positions. And remember, we select managers to manage our money. We don't, or we index. So index strategies obviously wouldn't make any changes. And then, the managers decide that they want to take it into account by changing some of the allocations or the holdings that they have. Then we'll judge them on how they do relative to their particular benchmark. So for now, no impact. A lot of these policies take a very long time to develop.
Very good. Thank you for that. We'll conclude with one final question. And the question talks about the composition. What is the composition of the investment committee? And it actually brings up an interesting point I wanted to close with anyway. So the investment committee that manages the assets of the San Diego Foundation is made up of 8 volunteer community members that have particular expertise in the institutional investing arena. At this point, I think all of our members are either institutional investment managers or institutional allocators of capital, which I think is important because it provides a broad array of expertise. And many of them have different backgrounds in different markets. Horacio has a lot of experience in non-U.S. equity markets. We have somebody that used to run a high-quality fixed income shop here in town. And so we're often trying to look for members with those different backgrounds and expertise in different areas of the market. We currently have 8 members. As you all know, Horacio has served as chair for some time and has been very kind, donating his time in joining us on these calls. And Horacio has actually, I think, served officially almost 2 terms now as chair, and will be yielding the chair seat to another gentleman, Steve Klosterman. And before I talk about Steve, I just want to thank Horacio for his incredible generosity to the San Diego Foundation. He's just been an absolute pleasure to work with. So thank you, Horacio.
Thanks, Matt.
Steve Klosterman, who has been a member of our investment committee for some time, is an investment professional in San Diego. He spent a number of years working with the UCLA Foundation and was also the investment committee chair of the UCLA Foundation. So I believe, and I think the committee and our board believe, that we're in very good hands with Steve going forward. And Steve will be joining me in the future as we work on preparing these webinars for you. So with that, I just want to thank everybody for participating. This webinar will be available on our website, and I'll turn it over to Adrienne.
Thanks again for joining us today and for partnering with the San Diego Foundation to maximize the impact of your charitable giving. As Matt said, the presentation will be available by the end of the day tomorrow on our website, sdfoundation.org/investments. Have a great day.